Okay, welcome everyone. Thank you for coming. So I know that most of the people speaking French, but tonight the presentation will be in English. And also, I guess we have also a viewer online. So thank you for attending that conference tonight. My name is Mehdi, and I will be presenting tonight with Marion. Both we are working together with the CCI among other projects. We're also working on the Pitch Day project. So the Pitch Day is every year we are trying to gathering interesting project locally in Shanghai, and we're helping them to prepare their pitch for ultimate sessions where they're gonna be able to pitch in front of investors. So we are trying to gather a pool of projects that we are filtering and monitoring a little bit, and we're hoping that we will have interesting projects this year and also potential investors also for them. The pitch day will be next June 29. So if you're interested, follow up with the communication of the CCI and come. I think it will be a learning experience for everyone. So tonight, what we want to do is to introduce a bit about what is angel investment, best practice, traps, tips. We are doing this in a very, very beginner way to make sure that anybody that coming will be able to apprehend those concepts. Yes. The summary today. So we were going to present ourselves. We're going to come back on the notion of what is a business angel. We're going to talk about investment thesis. We're going to talk about investing in tech startups. This is something that I'm doing since 6 years, roughly. We're going to talk also about how to get deals, how to manage deal management. What I'm going to do is I will switch off my phone to make sure I will not be interrupted. Just a first disclaimer before to start. We are not financial advisor. We want to remind everyone that this workshop is just for educational purpose. We don't provide investment advice. Investing in startups is extremely risky. So if you have to do it, it has to be at your own risk. And you need to make sure you do your own due diligence because you will own the risk, you will own your decisions, not us. Okay, so let me introduce myself very quickly. My name is Mehdi. I'm in China since 2009. So this is a picture of me when I was a kid. I'm still cute though. 3 things that I love: my dog, Japanese anime, and martial arts. So I guess this is a bit why I got attracted in Asia, but I didn't end up in Japan. I ended up here in Shanghai. My background, I'm an engineer background, so I'm a holder of information system master degree. I've got an MBA in business school. I went into engineer school. I went into business school. And since the last 12 years, I work in energy industry, retail, automobile, advertising, and now I'm working in nutrition and health, so-called biotechnology here in Shanghai. My work in the day-to-day, I'm chief information officer, so I'm building software product, whether for my internal customer, for my workmates, no matter if they are in finance, in supply chain, in logistics, in sales, in purchasing, but also sometimes for external customer when we want to interact, when we want to provide better service or new services. I will let Marion present herself.
So on my side, I'm not the funny girl because I'm a corporate finance advisor. I've graduated in business school, mastering in finance, and all my experience was from management control to now corporate finance consultant in a law firm. And so I've been here since 2004 already, and spent all my career in China. Now, what I do on my daily job, I'm assisting clients on the business model, business plan setup to raise fund, working as well on M&A deal on the valuation part. Whereas you have a target or you want to sell your company. And this is what I do on a daily basis. And on my side, I already invested in some startup, lost all my money, so I know what I learned a lot, and I know the risk behind it. But I would say that it was a good learning.
So the first part of the slide, sorry. So for the first part of the slide, I will present a little bit what I'm doing as a business angel, and after that, Marion will come back with some specific aspects to understand better everything that comes around legal and finance aspects. So first, how do we define a business angel? Most of the time, this is what we call a high net worth individual. That person, turns out that most of the business angels around the world used to be entrepreneurs. They made a great company. They turns out they got lots of money, lots of wealth out of this, and they want to reinvest. They want to reinvest, but they don't just want to sign up a check. What they expect is to be a little bit involved in the business. They want to take sides. They have belief, so they want to support certain type of business. It depends a little bit about the values that they have, which kind of future they want to build. So what they do is they're investing in little companies, which what we call early stage. So it's usually little teams, could be one person, 5 people, but it's always a very, very little team who try to achieve something huge. They're gonna finance, they're gonna sign a check, and they're gonna get equity. They're gonna get the shares of those companies. And for the best ones, they're gonna be active in that business. Active means they're gonna try to support the company by trying to adding some values. I'm gonna come back on it, and of course they expect a significant returns, but it's not just about the returns. It's also about what they want to do with their life. When they sign a check, most of the best business angels, what they want to do is they want to make an impact. And it doesn't mean necessarily that they're gonna finance social entrepreneurship or a charity. But they want to take part in a business that's gonna have values that they recognize themselves. So when we talk about investment thesis, the idea is a business angel need to know why they want to invest, or even why they don't want to invest. It's very difficult to know why you want to invest. So most of the time, what's happening, it's a bit like life when you do internship when you're young, you do lots of internship, you know exactly what you don't want to do until you found out exactly which type of job you want to do. So I'm going to talk about the reason for investing, what is interesting to know, what are the expectations from the investment. There is a methodology. This is an acronym very famous we use also in project management, the SMART methodology. The thing is, when a business angel is about to sign something, you need to make a bet on a team who's going to have specific assumptions. So you're going to have to share the same assumptions about a certain type of business, a certain type of market. But they're going to also have to look about some insights, measurable insights, what the team have done before. They're going to have also to bet on the fact that that team is able to achieve the goal they are pretending they can deliver. Can they deliver what they're going to deliver? It's something measurable too. Are we talking about a number of customers? Are we talking about a number of features in the software? Are they talking about a certain amount in terms of revenue? And time is limited. When a company takes some money, they're just buying time. So the question is, can they do that in the amount of time that they have? If they don't, they're going to lose credibility. If they don't have credibility, it could be at risk if they want to raise more, for instance. So, please come in. So the thing is, angel investing, this is the most risky thing that you can do. But this is also the thing with the most of the rewards. You have to get a specific mindset to make it happen. And I will explain a little bit why it's interesting. So this is just to show you that how risky it is. But the thing is, you can look the glass half empty or half full. Me, every time that I take a bet, I prefer to see about the potential, the risk. I already consider my money gone once I sign a check. I don't. I'm not afraid. Actually, that's one of the critical point of tonight. You need to leave the emotion out of this. At the moment where you sign, at the moment where you, even if, I mean, those companies gonna have a lot of bad things gonna happen to them. The question is, does the team will be able to deal with it? Do you betting on the right people who can handle this? So something which is, I think, who in the room, besides maybe Marion and I, who already invest in a startup? Okay, we got few people. Okay, but who already? I guess everybody already invested in real estate, stock market, cryptocurrencies. Nowadays, it's a very hot topic, right? So, okay. So this is not the same type of asset class. Even a service company is not the same type of asset class. Here, I'm talking about a startup who's developing a product, preferably a software company, because when you can leverage software, you can technically scale operations and you can resell the same thing over and over. So here, what I wanted to highlight with that slide is you have different stage of your startups. We call pre-seed, seed, later growth, expansion stage. Those companies can be just an idea with very few execution, just maybe some letter of intent of potential customers. But it could be also a company who have a product and have people using the product and doesn't generate revenue yet. Or it could be a company who generates revenue but are not profitable yet. And the best case is, of course, if they are profitable, it's already a very good sign. But you can see that there is three attributes that's important to define also your investment thesis. This is about how much cash you're gonna put, what are the valuation of that company, and in which industry they are. So first of all, you don't invest in something you don't understand. So you don't start to invest in a fintech, for instance, if you don't know what is fintech, what are the state of the art of the market. If you don't have an understanding of the market, you just don't touch it. You can study. I mean, it's good to explore too, but you need to know exactly where you put your feet. Then, as a business angel, you need to build a portfolio. So you're not going to do everything with just one bet. And building a portfolio, you don't make 10 investment in a year if you're just starting, because your prism is going to change. Your investment thesis is going to change. The thing that you don't want to do is going to add up over time. So, for instance, if you invest in one company only, and I'm talking with just few studies I read since 2017, you have roughly 20-25% chance at best, if you didn't make any other mistakes that I'm going to explain later, to have just your money back. Not even profit, just your money back. So, so it means that you don't need one, you need maybe minimum 10 companies to build a portfolio, a little portfolio to start. So, how to say? So you need to plan your budget first, because your cash is limited. You don't sign up everything you have in one bet. And then you're gonna, depending on the valuation of a company, your share will be limited. Your the part of a business that you're gonna own gonna be limited. And on top of that, if a company raise one time, but successfully raised over and over and over, because actually they demonstrate growth, they demonstrate execution, what will happen is you're going to have dilution. I'm going to come to it. It means that what you own is going to be reduced, but the value of the company that you own is increasing. So you need to know a little bit what is your entry point. So which industry market you want to go, how much cash you want to give, and which valuation. So this is just some example. Alors, nothing is in the marble, everything is changing also. But average, this is what I try to see. I try to stick a little bit nowadays. It's when a company try to raising around 500K, if they are not able to generate a little bit of revenue, not to not to be profitable, they are not profitable at that stage, but to demonstrate that actually that guy can bring some cash because he's able to sell something to someone that is able to answer to a problem that someone is willing to pay. And you can see that more the revenue increasing and potentially the expected money that is kind of raising is growing too. So I put some range, but there is nothing in the marble. You can have lots of startups that actually raise a lot too much when actually they don't really have those type of income. Doesn't matter which type of fundraising round they are calling themselves. Lots of people always they think that they're gonna raise one time and after it's gonna be Series A. It doesn't work like that. So you need to be aware that because of also with some current market trends, lots of people will take the trends and try also to raise money. So that's why we have so much entrepreneurs who want to raise money and make startups, but actually it doesn't really make sense. So you need to be careful and you need also to pay attention that those people shouldn't raise the serious people, the right entrepreneur who execute well. You have to make sense in terms of how much money he brings in and also how much money you want to raise. But this is just an example. Another example here, it's two cases of two startups. One tried to raise 1 million, another tried to raise 750K. What is interesting here is, so there is some keywords that Marion gonna explain a little bit later, pre-money, post-money evaluation. But what is interesting here is more you raise money, more you have a dilution effect. So it means that you're gonna own less, or if you're entering in that round, it means that you can take more as much as possible, but it means that you need to allocate a lot of cash. The point here is most of the time when you have a fundraising round, you can expect between 10 and 30% dilution per round. After it depends on the scalability of the company and the product that they have, of their technology, and the way they handle the business. What is interesting is over years, the best company, they try to protect their equity because they know the value that they have. They don't want to give it away so quick. Why? Because when it's not a startup, when they become a company, a real company with a mission, a value, a purpose, they're gonna have to make an employee stock option plan. In France, we call that BSPCE, because they're gonna need to make incentive also for the employee. Each employee that's gonna join the company, they want a piece, especially if it's an early company. So I know we have a startup employee in the room. Maybe there is plan for this in yours, and this is super important because it incentivizes the employee. And we don't want in a startup world, we don't want employee. We want people that stick even when the boat is shaking, and the boat is gonna shake a lot. So this is an interesting graph. It's supposed to explain what is the power law, or it's a little bit like the Pareto law for the one who are familiar with this. You have lots of VC funds. Some are specialized, depending of geography or depending of industry, or depending of the money that they have, basically, okay? The thing which is interesting is not all the funds are making the same money. Most of the time, 20% of the fund is catching 80% of the value which is created. And so this is interesting because it's also exactly the same when you take a look at the startups when you want to build your portfolio. You will have one or two of your startup of the portfolio of 10 companies that gonna surpass them, who gonna beat in terms of performance all of them. And also, I believe that in terms of business angels, not all the business angels are that good. Just a few. They know how to associate. They know how to pick deals. And lots of people trying, but not everybody is winning. So since the dot-com bubble is very interesting in the technological startups, because on that graph, which is interesting, is just the chart. You can read the rest, but it's I wrote it, right? But no, what is interesting is on that chart, it's you can see that all the value creation is made before IPO since the dot-com bubble. So it means that if you were an early investor of LinkedIn or Twitter or Facebook, you're actually making more money before it went public. And because of this, in the startup world, in the technological startup world, you have bigger and bigger fundraising round. So that's why you see in the media all of those fundraising announcements on and on and on and on. The thing is, it's better for even for a unicorn startup to have so much cash that they can stay private like that. They don't need to disclose anything in the public. More they remain private, more they can operate the way they want. And also it's interesting because it means that if you invest before, it means that you will catch a lot of value. But as you can see, 90% of the early startup fails. So this is also what I was saying with the power law or the Pareto law. It's not all the startup going to perform. Actually, when you build your own portfolio, every time you make a bet, you have to make sure that, how to say, you have to treat each deal independently. Like this is the only one that you will ever made. You don't think, oh, this is the 5 company I want to invest. I already have 4. You need to think completely independently like it was your only shot. This is very important because it changes your prism, the way that you're investing. For instance, so far I invested in 40 plus company. I did 3 exit. I can already tell you that there is 10 company I made a bad investment because I didn't think it right. I didn't learn enough things in between. I was always thinking the same. The way that I'm thinking now when I analyze a deal is changing comparing to the next 6 months and the next 6 months and the next 6 months. So this is key actually. So every day you're learning, actually you were wrong on many things. So how to get deals? This is the key topic. This is what matters is not the money. What matters is the deal. How do you get the best deals? How do you get the best deal when actually everybody trying to be an entrepreneur, when everybody trying to fundraising today? So there is many ways. One, if you are known to be an investor or an angel investor and you're in different groups. Me, I receive emails, for instance, today, but I have to market myself on the social media. I'm here today in the events, so now you know. So if there is a future entrepreneur that wants to start something crazy, send me your pitch deck. But it's not only, there is also some platform. In USA, for instance, there is a huge, very famous platform named AngelList. You can subscribe on it. There is a lot of investors, there are lots of entrepreneurs on it. And you can also access to some deals. It's submit to regulation with the US SEC Security Exchange Commission. Not everybody can invest in the US territory. You have also in France, for instance, there is one company called Angel Square. You have to pay to access to some deals. Doesn't mean that the deals are the best, but there is deals there, but there is also other groups like tonight, the CCI, we are trying to build a community of investors. So potentially in the room, you can also connect just after when we're going to have some drinks and maybe you're going to make a meaningful connection. But also, you need also to build connection with other angels, other entrepreneurs, to keep the relationship, to develop the relationship. Me today, I'm working with over 20 business angels on a regular basis. We invest in similar business. We invest in common business. So we are on the capitalization table of some of the startup, but we share also new deals because maybe we want to challenge ourselves. We want to know the insights that the one have and have not. We want maybe the prism of someone else. Me, I'm a tech guy. So when they send me a pitch, it's because there is some kind of technology and they want to know what is my opinion about it. So this is also very key. You can also connect with people from family office and venture capital if they are okay to disclose. Sometimes you can build some relationship, and sometimes they can also let you have a look or even collaborate. It depends of what can you bring to them, what can they bring to you. But in the end, investing your money is scary. I don't like to lose money. I like to earn money, of course. So there is 2 questions that I like to ask myself every time I invest. The first is, why should I invest? Do I have a clear understanding about what this company is doing, what this company can do, what is the threat, the opportunity, the strength, the weakness? And also, can I add some value to this company or not? If I cannot add value to a company, even if a business is interesting, I could sign something, but I will not be very helpful. And me as a business angel, I like to be very, very active actually. So this is fundamental questions. And it also requires to have a lot of self-awareness to know what you can bring, what you cannot. Because we are human beings. We have a lots of bias. And sometimes we could invest for the wrong reasons. So you need to know why you need to invest, which type of future you want to build, what are your values. And you need to see if your values is resonating with the team that you are connecting with. So you need to set up some investment criteria. So most of the time, investing in a startup today, and it's today when the economy is still changing, it's a marriage for 5 to 8 years. You have to think like that. I'm not saying that you couldn't have a better surprise before. It could also die in 1 year. So, but you need to think this. What do you want to build in the next 5 to 8 years with those people? So, of course, you're looking for financial returns. Is it something? Are they doing something that you are passionate about? Is it something that matching the value because they try to, I don't know, to make a solution that's gonna make the world carbon neutral, for instance? This is a very high goal, so it means also it's very risky, but it means also that those teams have a very, very huge ambition. You need also to think about it as it's not just about when you're gonna have a deal and make a decision, but you have to commit to do some research most of the time, always about those markets that you already know, to understand what's going on, how they're gonna evolve. If there is a shift of market, what's happening between countries, where the technology that has developed in China and the ecosystem that is developed in US or in Europe is completely different. In some place, there is fragmentation, it's not there is convergence. So is this a play that you want to take? Is it something that you want to plan? So will you be active or passive in your investment? Which type of relationship you will develop with the CEO? How early do you want to get in? More you get in early, and more it's risky. But also, there is also more rewards. So it depends. Do you think you can bring more to a group of 5 people or to a company of 15 people who already know their business model? Don't let emotion get in the way. This is, I think, the biggest thing. Diversification is key. For instance, in the company, I started in software as a service. So it's basically, this is B2B company who provide a piece of software, you pay a license, and the company can use it. The thing is, when I did some, one of the company I invested was a HR technology company. So it's an app that they deploy in the company. The employee can use it. They can discuss together. The management can submit some topic and get back some feedbacks. The thing which is smart, it was analyzing the sentiment of the employee because sometimes there is some topics in the company which is difficult, and the company is able to see in a big dashboard if they can operate change or not. Once I invested in an HR technology company, if I see another company doing the same, I will not gonna invest. The goal is not to invest in all the HR technology company who's doing kind of the same solution. You need to make different bets. You need to diversify. A VC will not think like that. I will give you an example. In 2016, I remember I saw a crazy company, a medical device company who was doing a connected pacemaker. And the IP was great. The team was great. Everything was great. The valuation was crazy high. And if I have to sign a check, it will be the only check I will give for a very, very long time. I took the time to do some research. And I discovered that every year there is 150 companies very similar around the world. So if I have enough money and only one succeed, so if I have enough money to sign for the 150 company, yes, I can do it, but I don't. So I know that this is not for me because it's the ratio 1 out of 150. I don't like it. So focus on what you know and understand well. Also a thing to, it's about managing the risk. So if you reduce your risk, you optimize your chance. So I like to invest with other angel network. I like also when there is a family office or when there is venture, even some VCs sometimes, early VCs. They are more and more. Actually, the VC environment is changing so much. Lots of new VC appearing and making money and are taking over. So what I like to do is with more investors, you can ensure that more people will pay attention to so much detail, not just the technology of the business, but also the legal framework around it. But in the end, you need to maintain a consistent and methodical approach to checking everything that you need to make your own decision and do your research, because there is a lot of so-called angel investor or young angel investor that doesn't do research. When I signed my first check for a company in 2015, I did nothing for 2 years. I was very lucky to have an exit. And after I got money and I said, oh, now I should do more. But I didn't learn anything more in 2 years. And then I realized it was the first switch. So doing some research always, not just when you have a deal to check. So this is the thing that I try to look. This is very common, actually. You can find it on internet, but it's I pay attention a lot about all of this. So first, I would focus on the business. Does the company that pitching me have a business model? Yes or not? Is it a proven business model? If yes, they should have traction. They should have customers, potentially revenue. I like to look about the evolution of turnover. Is it growing? I'm checking how much money they burn every month, how much money they have in the bank. I'm checking if they have growth. How do they define growth? Visitor on the website is not necessarily just growth. How do they bring that traffic? If they have users, do they have retention? But this is more of the product part. When it's a B2B, I like to pay attention to the sales cycle, to the sales funnel. If they masterize it, do they understand what they are doing, how they get their customer? And after, how much time, which type of problem they are trying to solve? Is it an expensive problem? Is it a problem who happen every time on a regular basis? That it ensure that it will have recurrent revenue because people will have to pay again and again? Does the customer concern, do they want to pay? Sometimes you have no idea, but in the B2B world, there is so many companies who have so much problem. And even if they say that this is an expensive problem, they just don't want to pay. So it's crazy, but it happens. So you need to pay attention to those little things. And after, when it comes about what they are building, I like to pay attention to which type of product technology they use, but how does their product is different from the competition? Do they have something unique? Are they developing that well? Does their technical team is really, really gifted? Does their technology is scalable? How do they defend their technology? What happens? Is it because they keep the data of their customer? So the customer have to stay in, and if they want to move to another platform, it's going to be difficult? Or is it difficult to connect this tool with something else? So they have to make some specific development, customer basis. So it's not very scalable, even if it makes money. Is there a network effect? A network effect is basically like the first rule, the first to define what it is for the people who don't know. Network effect is like Facebook, like Uber, like every platform, or even like the telephone. More you have people using the telephone, more it's interesting and more it creates value. So if they are the first to come on the market and they have a network effect, this is interesting because more they bring people and more they're going to build their defense. People will not, a new customer will not go to the competition if they know already that there is value which is created with a network effect. And also the user experience. So no matter the company I'm investing, I like to try the product, even if I'm not concerned, but just to see how is it working. And after, and this is the most complicated because you see what happens on customer and market, what happens about the business model and the traction, and what about the product and the technology. All of this can be changed, iterated, modified, but this depends just about the team. So on internet, you can see there is a lots of investors that can tell you, me, I choose the team, me, I choose the team, me, I bet on people. This is not a bullshit play. This is actually very, very important because at the beginning, besides the team, there is pretty much nothing. So what happened is I made a list on the things that I like with the teams when I try to pick the teams. So most of the time, I try to have a meaningful conversation, meaning no bullshit, no bullshit, no bullshit. And I can tell you that this is very hard because when they come to pitch you, they describe you a world perfect with no problem. Me, I want to know which problem they encountered before, and they try to not detail them. So if someone doesn't talk to me about problem, it's not normal. So what I like also is if the founders or the founder team, if they are humble. And by this, it's easy to demonstrate humility at the first call. But when a company got traction or when they got PR exposure, they can have some kind of self-inflated ego. So it's interesting because if they have an ego, it means that they're not going to build a company to building a business. They are building something for themselves. So I try to avoid. After, it depends about the management skills that they can have or they have to build. If this is people very slow but excellent who build something really, really good in terms of quality, I try to suggest them when they hire to build fast people, because what they're going to need is velocity and excellency. So if a founder is excellent, I advise him to go with fast people and if someone is very fast but do the thing halfway, always a bit dirty but have quick wins, I suggest him to hire people which is really, really excellent craftsmanship, artisan. So this is the thing I try to check. After, with the discussion I have, I want to see if the founders will expose openly the vulnerability. Most of the time, it's not an easy exercise, but the one they do that, they can technically build a culture. And the culture in the startup, this is the glue. This is the glue in the boat. If you bring lots of people together and the boat is shaking, I can tell you that all the employees gonna leave. But if you have problem in the company, even just to pay the salary the next month, and you're able to disclose that with all the employees, and all the employees, they feel okay about that, it means they stay for something else. And this makes the difference between the great team and just a team. And it's not about the idea again, because I can tell you that the wrong team, I prefer to invest in the best team. With the wrong idea, they can still change the idea and change their model and change their business and change everything. So it's a little bit like a parachip. They have to stay, on the parachip, you say that most of the time, the people which is on board, they have good reasons. Otherwise, they have been thrown away. So I like the idea of a parachip. Then I try to pay attention also to what they says. If they bring some PPT, just PPT with lots of market data, but they don't spend time with customers, they don't sit with potential customers before their business for 2 hours, trying to understand everything about who they are creating value for, doesn't make sense. What else? Yeah, so I want them to have a mission, a promise, a purpose, because the employee will have to deliver the same purpose. They're going to have to have values, to have a vision of the company they want to build. And I like when the CEO or even the co-founding team think themselves as not just as employees who are going to stay forever because they're in the founding team, So most of the time, even if a business is successful, you have lots of friction in a team. And I try to see in the founding team if they can manage the ego of each other or not. If they cannot, if I see that, just you pay attention to the body language, if you see something wrong, you can know that at some point it's going to implode. So that's why also I try to not just talk to the CEO. If there is a founding team, I want to talk to the founding team. And not just one time, maybe 2 times or 3 times max. And after I make my decision on 2 months, 3 months, and I check the evolution of their business. So, for instance, once I was discussing with the founding team, there were just 4 people, and all of them, 1 day a week, one other person was doing the customer service. It sounds stupid, but when you have a company, when all the employees, they spend time discussing with the customer, even if the person is a tech person or a logistic person or a finance person, all the employees, they know about the customer because they discuss really with them. This is something unusual. And when you want to invest in a startup, what you want is a singularity, is something unique, something different. You want a home run. I was saying earlier that when you want to invest, you invest like it was the only deal. So it has to be something unique. Yeah, I think. Yeah. Also, I don't like when some teams or funding team they don't execute, so they have nothing to share in terms of learning, and they tell me that they're gonna raise money to outsource things that they don't understand. You don't outsource things that you don't understand. They don't know how to code. They should start to learn to code a little bit. Otherwise, how do they want to recruit some technical guy at some point? Doesn't make sense. And okay, I want to say for business angel, you have to remember, because this is really, really cool, because as an activity, you get to finance the future. I think it's easy because it's not you who's doing the hard job. This is the founding team. And I think it's very comfortable because if you do it well, you make money. And you make money even if a company fails someday, doesn't mean that it doesn't get acquired first. Yeah, that's pretty much it for me. No. There is almost that.
So just if we go to the basic for valuation, maybe before going to the detail, I just want to say something is that there is no perfect or right valuation. Valuation is an art. It's a mix of art and science. And this is why we usually, when reviewing some potential deal, we really review different type of valuation to make sure everything is matching. So I will go through some concepts and then later on valuation that are usually used in the market. So first thing that you will always hear in company valuation is enterprise value and equity value. It's important to understand the difference because at the end it makes a potential huge difference in your pocket. So maybe we can go through the chart and the small graph, which is the explanation. So for example, the enterprise value is, for example, your house, how much your house is valued. So let's say 100. And then on the right, so this is really the enterprise value, the house. On the right, it will be how is your house financed. So let's say you can buy it cash, the shareholder, so you put your money, or you can go to the bank or whatever financing company. This is what we call the debt. At the end, the equity value of your company is different from your enterprise value. So this is why we say enterprise value is equivalent to the asset of the company. And the market, the equity value will be really the methodology to understand how much can be in the pocket of the investor. So this is one thing. And after, of course, you have many complicated formula that I will not go into the detail at this stage. Then you have different type of valuation methodology. You have the quantitative methods and you have the qualitative one. Usually you always mix both. So the first thing will be the quantitative methodology with keywords that were mentioned before, the pre-money valuation, which is the money or the value of the company before the investment, before the cash you inject in the company. And the post-money automatically is the money, including the pre-valuation plus the cash you've invested. Then if we go to the quantitative method, first thing is the DCF, discounted cash flow method, which I will go a bit more into the detail later, but this is the basis where you will review, in fact, the P&L of the company. You will have the balance sheet and the cash flow statement. So this is where, based on the previous activity and the future growth of your company, you can estimate a value. And mostly, I would say in pre-venture capital, pre-venture investment, you will use the venture capitalist, which is just based on the ROI. I'm an investor, how much I want to get when I exit the company. What is the multiple I want to get from my investment? So this is a quick one, where an investor can, or business angel can think, okay, is it interesting? Is it what the kind of investment I am interested in. And a third method, it's comparable method, which appears in fact to be easy because you'll say, okay, I'm going to compare the target company with potential competition. So you have many websites where you can find information online. However, it's always super complicated, and we try to use it on a daily basis in my company, and we realize it's super complicated to really find exactly matching company. Why? Because maybe it's not the right timing. A potential investment that you did 10 years ago or even 5 years, 3 years ago, it's not anymore the same market condition, so it's difficult to compare. You might not have exactly the same IP or trademark that belong to the company. You might not have the same team. So very difficult, in fact, to find comparable. However, it's a tool to help you assess the potential of the company, the potential of the future rewards. So you use it to try to find comparable, but I would say it's more really to support all your previous estimate on, for example, DCF methodology. So just to go back to DCF, because this is the most complete method that we have. This is a methodology where you need really to make your job when you build as an entrepreneur, where you will build, in fact, your Excel table from the previous years or previous months where you already probably spent some money, generated some revenue. Based on assumption, you will be able to build potential business plan. So usually you do it on a 3 to 5 years basis. But to prepare, in fact, this report, what you will do as well is that you need to do your job. As an investor or business angel, you will do your job to review the market, to review the potential, to review everything that will drive a potential growth and success. But of course, as the entrepreneur, you need to do the job first because it will be assessed by the potential angels. And in this model, you will apply something that will be assessed by the angel as well, which is the discount rate, meaning the risk that you can estimate on the company, on the project, based on the market, based on the stage of the growth of the company, based on the fact that you only have a POC or you already tested really into detail your market, or the fact that potentially you already have a business working on a market, let's say geographical market, it's working well in China and you want to expand this company in another region of the world. So you have to assess many assumptions to really show to a potential investor that you know what you are doing and in which environment you are building your company. And to put it back as the investor, it comes back to the due diligence list we were mentioning before. All these hypotheses, all the story that the entrepreneur has created, has written, is sellable or buyable from someone who wants to invest in the company. To come back to the methodology, so I was mentioning the quantitative. Now we have the qualitative methodology. All these qualitative methods are subjectives and helps, in fact, to assess the potential of the business. It's a way to ensure we can understand all the risks, understand by going into a checklist what is the potential value of the company. So here we put the four known methodology, which are the scorecard, factor summation, the valuation by stage, Berkus method. All these methods can be found into details online. And it's a way as well to give you a range of what should be the valuation of the company based on several criteria, such as is there a prototype, does the idea seems has potential, the management team, what you already did for your company. And this is why we just put on the right the criteria that we should always use in the due diligence. And we start again with the strength of the management, which is key, as it was mentioned by Mehdi, so I will not go back on it. And then all the assets owned, so we were mentioning trademark, for example, or if you own something and you already registered it in terms of legal way, in terms of the financials of the company, of course, where you are in terms of revenue generation, how much you invested already in the company, what is your needs for the future, the size, where you want to go. So all these criteria that are super important to assess when you review a project. So what we do usually when we prepare entrepreneurs to raise funds is really, of course, to do the Excel part. So first, we will always start by challenging the business model. This is the first thing which is important. And then we will go to the financial, and then to ensure that in terms of qualitative aspects, they will be ready, in fact, to answer all these questions, because we know that angel will look at it. And this is probably one of the major mistakes I did in my previous investment, is that, okay, I was reviewing financial. Do they look okay? Yes, it seems that it's doable. I believe in the project. But then I was not going through all these criteria, and especially one of my investments was a super flying project, going well, lots of revenue, growing fast. The entrepreneur was someone super successful. But I remember when investing in the company, I was thinking, okay, the main risk of this investment is the founder. And I was so believing in the project, so motivated by this project, that I still invested. And several months or years later, when it did not work out, I came back to my initial feeling like, okay, I knew it. He was the main risk, but I did not follow my instinct, or I was just into emotion. And this is where really now I really try to assess all these criteria on every project I am reviewing, or every project where I have to prepare as well the entrepreneur, like, okay, are you sure you want to do it? Why you want to do it? Do you understand all the risk, and so on? So yeah, this is what I wanted to insist on. One aspect as well. So on the financial, this is the small introduction I wanted to do on the financial aspects. One thing that we wanted as well to mention is that usually when angel will look at a project, they will mainly focus on analyzing the project, and this is of course the first step to do. But there is something else that has to be done when this first step has been completed, and you think, okay, I'm really willing to invest in the project, is to look at the legal terms, because you need to have a strong or protecting term sheet, or at least to understand all the legal aspects. And when you sign, it's a wedding, so it's a contract, and it's boring. Let's say it, we can say it. However, it's important because if there is a new fundraising, because of course it's not going as it was planned, so you need to refinance the company and so on, you might have some dilution that you did not understand. First possibility. Second possibility, you might have an issue with the management, or it might not be the good founder, but you have someone to replace. What happens if the founder is leaving? So there are many questions that needs to be digged into to ensure that even if the project is working, you might not lose, in fact, what you invested at the beginning. So this is something that I'm not a lawyer, Mehdi is not a lawyer, and this is something that we could go into more detail in a second workshop if you feel interest into it. But I will stop here for tonight. So if you have any questions, this is the time. If we have some time, Alex, we do? Okay.
First question. Can you give me one real example of your successful investment? One real investment.
Yeah. Alors, don't worry.
Successful one.
My 40 plus project, they are all real investment because my money is really gone into those companies, and I saw it on my bank account. It went away. So what I define success? Okay. Based on my portfolio, for instance, I've got free exit. It means free company that has been bought back. Okay, and I got money plus some profit. One, what you want to know? What you want to know what they are doing, or you want to? Okay, but the first company, for instance, their name is Plateau. When I met them at the beginning, it was an app who was doing expense report. Okay, you are taking a picture of your FAPIA. And automatically it was giving you in an Excel file, uploading online, and you could share it on a Slack. Slack is like WeChat Enterprise, but in USA, or Dropbox or Google Sheet. That company, those guys were great. It was a team of 3 people. One business guy, so he did a business school. One was a designer, and another was an engineer. So it was a bit a perfect triple team. It's not always like that. What happened to them is it was my first check. We raised 300K in total. They raised 300K. Okay. What happened is they had barely 1 year of money. After 6 months, what happened is they got selected into an accelerator called Y Combinator, which is based in San Francisco. So they have to move to USA. That was one of the conditions for 3 months. They got money. They received $120K, but actually in USA it's so expensive. It just covers the 3 months where they're gonna stay. In 3 months, they have been exposed to other engineers, other startups, other investors. They learned a lot. And they completely pivot what they were doing. And now today, and the company is still existing. And now it became a platform that they built on Slack. And it's a platform of mentoring for CIOs, CTOs, experienced IT guys to young IT guys. And the reason they were doing that is because one, they wanted to have something with a purpose. For them, it was not making sense to just doing an app with expense report. And the thing is that platform of mentoring is to teach soft skills. And IT guys, we are not good with soft skills by definition. We are good with coding, we are good with machines, but we are not good with humans. And the thing is, in the Valley, for instance, you have high salary for developers, and the talents are very, very expensive. And there is no tools to develop them. And when you have a technological company that actually is growing, but the first IT guys, the first developer who were there, they become managers. And they don't know how to manage. So this is the first company. You want another one. The HR technology I was mentioning before, their name is iPhone. And it was the company I was telling you, they deploy some kind of chat internally. And what they did actually is they were analyzing the sentiment of the employee. Okay, so it was recorded and it was feeding an algorithm. So they were using what we call a natural language processing. This is a sub-branch of machine learning, which is a sub-branch of AI. And they have been acquired by a cloud HR company who have a portfolio of HR tools. Another company, their name is AX Draft. My portfolio is visible on AngelList. Huh? There is so all my company, you can see it. Huh? And AX Draft, it's a Ukrainian company, my first Ukrainian company. Maybe the only one ever, I don't know. And then they were doing automatization of legal contract. So they make your contract, you make your template, and there is some specific part You know, you change the name, you change the address, you change this, you change that. And the idea is to generate contract very quickly. So, and it was for B2B. So they had some legal firm who was using that to be able to generate, and it's a license. It's not that you can make as much as contract you want, but it's automation, you know. But the idea it was to, it costs a lot when you do a mistake in a contract for companies. You do one mistake and maybe there is a clause which is not applicable, and then suddenly you have a conflict with a partner, with a supplier, with a customer, and then your contract does not hold. So so it was an expensive problem they were trying to solve. Potentially, yeah. Also, it works too. But bon, voilà. It was those three companies. But I don't think this is success. If you want to, for instance, there is bigger bet I've done. There is one company which right now they are more still scientific. They received lots of grants, and they are working on a device that can catch the CO2 emitted on an industrial site, on a factory, and that CO2 they can change it into fossil fuels. And this, for me, right now, when we are talking about Salesforce, we want to be carbon neutral, Microsoft, all those companies right now, there is not enough solution addressing that type of problem. And those type of problem, I believe it has big impact, big return, big risk, because not a lot of innovative solution for the environment today. So this, for me, if this type of project succeed, I will feel very proud because there is a difference between at the beginning I was investing into software company because I understand the software, and now it's about what are they trying to achieve. So and I have few other company around electric vehicle, around telecommunication. How do you make the internet faster, cheaper? So, voilà, there is few things like that talks to me today. But there is business that I think I would have said no, even if it's good business. I don't think I would have said yes to something like Facebook because I don't like what happened with Cambridge Analytica, with the fake news, with all the racism that social media spreads. So it depends also on the value. And this is also the key. It's because all the business angels and all the entrepreneurs, it's about how do you associate yourself with who and why. And lots of people doesn't associate themselves for the right reasons. So that's this is also what Marion was telling. Yeah, yes.
Yeah, I got a question regarding these three exits. When did you know it was time to? Sorry, apologies. Regarding these three exits, when did you know it was time to exit?
I didn't choose the time. It's not me who choose. We got an offer, so it depends. So the first one, for instance, it was an early acquisition made by a private investor. He met them, he loved them, and he proposed to buy at the lightest valuation. So the company, the first company, they went into 3 rounds of raising. Me, I came to the first one, the pre-seed one, when they have basically nothing, just a prototype. And 2 years later, so they raised after the demo day, after the accelerator, after they raised with Slack, who get into it because they built the platform on Slack. And that private investor, they discovered them, and they developed a relationship with the founding team, and he said to buy the company. I think it makes sense with my other business. He made an offer. The CEO, alors, those kind of rules for acquisition and buying is also defined in the dans le pacte. Comment tu dis ça en anglais? In the shareholder agreement. So. So they made me a proposition, and the proposition was based on the lightest valuation that the company had.
So basically, the company bought 100% of the equity.
Alors,
you got.
Alors, to be honest, no, they didn't bought everything because I didn't decided to sell everything. I sold the half because I wanted to keep a foot because I liked what they are doing. So, and they said, okay, because they had no other choice. So the guy bought 80% and I'm still in, and another business angel is still in, and it's still interesting project. So I following them and I keep supporting them. The HR technology company, for instance, it was tricky because You had also a VC who had shares. The VC wanted to make special terms for me and the special terms for and not the same term for them, when actually we all had the same rights. So this is why it's important to understand the legal terms. I didn't want to talk about it because it's kind of boring, but it's also super important and strategic. In the end, all the business angels, we talk also each other. So we see what's going on. And in the end, when you back yourself from the beginning and you know what you're getting into, you know exactly which decision. And if you don't sign, they cannot proceed. So, and in the end, we find an agreement and we left happy early after.
Super. What kind of multiple are we talking about for these three investments?
This I don't have to disclose it.
Because we don't know the original investment, we can calculate.
Yeah, that's true. What I can tell you is, 6 years ago, it was easy to put 20K euro, or dollar. You can put 20K because I didn't have so that much money. But now, truth is now the average ticket for a minimum company tend to increase. So now it's more, it can be 20K up to 50K easily. And it's also a negotiation about the company. So it depends about the valuation. When I was talking, it's about the valuation. It depends about the valuation, how many money they want. Some founders, they agree to have lots of people at their cap table. Some they don't want, and they say minimum is that amount of money. So it's also interesting because you see the persona of a founder, and you see actually if do they value what I bring or not. It's interesting is the good founder also, they don't just want the money. They want to know what you can do for them. So, and this is a criteria. When some others, you said, oh, okay. So you have kind of both worlds. Oh, yes. Sometimes, yeah, of course. When there is a deal I liked and I went in, if I know there is another angel, because I say I roughly keep in touch with 20, 30 business angel. We share deals. And when I share deal, I don't share a deal that I didn't went in. Or maybe it's because I want him to look at something special because we are doing some research on a very specific topic. But otherwise, I say, hey, I don't forward a deal that I don't get in. I say, hey, I just put a ticket in there. I think it's interesting. Have a look. Make your own decision. So, yeah. Et on avait des questions en ligne, je crois, non? Ah, yeah. Yes.
So what's the typical equity you're looking for when you're investing in like an angel deal? Like what kind of percentage are we talking about?
I don't care. What I care is the valuation. Most of the time, I love it if it's 1 million valuation, but roughly most $4 to $6 million when it's in France, for instance, very early stage. Not deep tech, for instance, that took years to grow, etc. But in USA, the same type of deal, right away, it starts $15 million. It also depends on the ecosystem of VCs around the world. In USA, everything is bigger. Everything is more expensive. In France, it's undervalued right now. In London, it's more expensive. In Berlin, it's more expensive than Paris, but kind of similar. So you have also good, interesting thing. Germany. Very good question. China, the thing is, I don't invest that much in China because China is blurry. They don't give you the right information. I think this is overvalued sometimes. The thing is, it's not that there is not good opportunity. I'm a foreigner and I'm not Chinese. That's just, I don't have the right network. Maybe you can partner with Chinese. Yeah, true. I'm open to it. I discuss with some VCs all the time, even Chinese VCs lately, some different trends. I hope that if they can disclose some of the deals, I would love to. I'm very open to that. I receive some stuff sometime, but it's always huge fundraising, not enough explanation. So I don't get it. And I don't invest in what I don't understand. So
I'm just going to switch quick about the question we received online.
Yes, sure.
The first one was, Mehdi, you were mentioning during your presentation, doing your research in a few hours. And could you maybe develop the example of the case of medical devices? How can you find 150 startups every year for pacemakers?
Alors, yeah, okay. For that case, I didn't found the 150. What I did is I was discussing with my network of business angels and VCs, and I understood some VCs are specialized on some topics, and some are specialized in the medical device or healthcare, and they disclose with me. They said, okay, for the case of the pacemaker connected that I found at that time, it was a company in Switzerland. So they had IP from a university. So it was very serious, very academic, it was very solid. And what happened is I discussed with a VC specialized in healthcare and medical device. And the minimum ticket for that project was 150K euro. Okay, so it was whether I put everything I have and I pray, but the thing is I was hooked. So what happened is I discussed with a VC that I know very well on the topic, and they said, "Dude, there is 150 case like this." And on top of that, when you do research on internet, you can find there is, for instance, there is Crunchbase that I use a lot, which is a database online with lots of startups who get registered inside. They also registered their information about financials, their fundraising. It's not completely up to date because not all the startups have to disclose how much money they took in and everything. But if you start to make some extraction and some analysis, that gives you trends. So now Crunchbase, I use it every day. I made some specific queries about specific topics. So I receive automatically some reports about software in some region of the world on some key topics. And so you need data. You need data. But there is tons of tools, maybe in another workshop, why not? The tools for Business Angel, and I could disclose what we can use. And there is another question, right now?
Yeah, there's another one. Well, you started already to answer, but you said as well that it would be good to have minimum of 10 companies in the portfolio
for a start,
in order to start. Yeah. So what about the average amount of the checks at the beginning, and also what would be the amount of money minimum in order to start an angel investor's journey?
20K is a fair amount, I believe. After, it depends. We're talking about very, very early company, maybe post-revenue, but not yet profitable. A thing which is interesting about the portfolio, yeah, you have to start with 10 to have something comparable. But the thing which is interesting, I was comparing data from 2017 to 2020 from Y Combinator, from FG Labs, which is an investment fund led by Fabrice Grinda, one of the best business angel French in the world, based in New York, from Wharton, which is a New York university who have lots of entrepreneurs who start their venture just when they graduated. Which is interesting is we can see that a cycle is roughly 10 to 12 years for a business angel. And if you want to maximize your investment, you need, for the best business angel in the world who appeared in the past so far, it's between 100 to 200 startups in your portfolio, 200. So this is a life commitment. Even 10 companies is a life commitment in a way, So 200 startups, imagine that on 12 years. And for the best ones, they end up with what we call an internal rate of return. So the rate of return of investment at the end, when you do all your calculation every year, between 12% to 27.5%. So me, I know that I will go to 100 startups. If I have more cash to deploy, I will go to 200, but I'm targeting between 12 to 27.5 because statistically, this is what data proved me so far. Maybe after, there is always the odds. We talk about those billion-dollar companies. It's very difficult to find one. Statistically, investing in a seed company and getting a billion-dollar company, this is a 0.02% chance. So it's very difficult. And then you can have a 50x or a 100x. But today, when I target my company, I expect a 2x, a 4x, a 10x, a 20x. If I have a 50 or 100x, I will be very happy. Maybe I will learn a few things also along the way. Voilà.
Okay, just to finish, one last question.
Yes.
For Mr.
Thank you. I have two questions. One is for Mehdi, and another is for Marion. The first question for Mehdi is that for the previous experiences or the practices, have you ever tried investing in Chinese companies or Chinese startups?
Alors, okay. I did one Chinese company, Chinese startups, foreign leaded. So it was a foreign year of a CEO. And it was before to understand that a foreign CEO, technically, if he doesn't have a Chinese founding team with him, founding team members, success rate is very, very low, nearly impossible. The only one that I know that did something crazy was the founder of Tunar, who has been bought back Baidu for $400 million. But unfortunately, I don't have more example like this.
All right. The second question from Aaron is that, because I totally agree with you. You said the investment is kind of art, but I think like the art could be properly played based on figures. So like for us, we are like a startup, like focusing on live streaming. Because right now we have the team, we have the channels, we have the customers, but we don't have numbers. Of course, we will have numbers like for next 6 months or a year. So how does it work for the valuation of the company if we just get started?
Okay, so you're a startup doing live streaming, and you said you don't have numbers. Which type of numbers?
We just get started, so we don't have the numbers for in terms of like turnover or like the revenue or something. We just have like some tests.
Do you have viewers?
Of course.
Do you have their attention for a long time?
Sorry?
Do they come and they stay? Very long time.
Because like I think like we are not like creating some accounts. Like we are a platform. We just try to like set up like a different like influencers and brands. And it's basically it's more like a marketing for something.
Okay, no problem. But if you can make the people who come on the live stream, the viewers, if they come and they stay long, or if they come and they come back and it becomes an habit, and you have a cohort analysis, if your cohort analysis show that the people stays, this gets financed.
And just to add up, in fact, we are currently working with a startup in China, launching a platform, and it's the same. They don't have, of course, revenue, and we're analyzing Vimeo. I don't know if you know this platform, Vimeo, and in fact, they raised fund over 5 or 7 years before generating revenue. So what we will go for the first pitch, we will just go on this number. So the one part of the one Mehdi just mentioned, and we will go on how much you need to grow. So how much you will spend to grow, in fact, your market, in fact, how to say, growth, the new customers, how you will attract them, how much marketing you need to spend, how much you need to develop in terms of platform, in terms of technology. And then we will try to finance or to raise funds based on this need. So it's really cash flow needs, because you will lose, of course, you will not be profitable for many years. So can we find people who are trusting you and who are trusting what you bring on the market?
And this is our LinkedIn QR code, like that you can scan, we can network, just saying.
Okay, so just going to conclude. Thank you very much, everyone, for joining us tonight, and as well for the online participants for joining us. If you have any questions, for sure, for the offline people, you can share it with Mehdi and Marion around the quick drink right now. And for the people online, you can contact us, CCI, and we will put you in contact with them. Thank you very much, everyone, again. Thank you, Marion, and thank you, Mehdi, for sharing your insights.